In a world where markets transcend borders, valuation isn't just a number, it's a cornerstone of global finance. Every day, across continents, valuation guides pivotal decisions, from mergers and acquisitions to pension fund investments. It forms the bedrock of financial reporting and is vital in assessing the financial health of institutions. But how can we ensure the reliability of these valuations? The International Valuation Standards Council, or IVSC, plays a crucial role. As a not-for-profit global standard setter, IVSC works with partners throughout the world, including valuation professionals, regulators, investors, auditors, and professional bodies, to develop and set the international valuation standards. This globally agreed framework is applied by professionals in more than 100 countries. In a global marketplace, inconsistent standards pose significant challenges, affecting quality and professionalism. These variances can reduce transparency, create uncertainty, and increase risks. Today, the valuation profession is more important than ever. In tackling climate challenges, robust and comparable valuations are vital. They can support climate-conscious investments and enhance climate-related financial disclosures. With the rise of intangible assets like intellectual property, research, technology, and data, international valuation standards are vital for de-risking financing and fueling innovation in knowledge-based economies. The accurate valuation of financial instruments is also paramount in our growing and complex global capital markets, which exceeds $100 trillion today. These valuations are essential for the accuracy of financial statements and pivotal in guiding informed investment decisions. And in developing economies, international standards underpin economic development, promoting transparency and helping to attract the inward investment needed for growth and stability. In these arenas and others, the IVSC, along with our members and sponsors, champions quality and professional practice in valuation globally. Because international valuation standards don't just benefit the financial sector. They are a catalyst for sustainable, thriving markets and interconnected economies.
Good morning, good afternoon, and a very good day to you. Welcome to ValuAsia Connect, a webinar series on valuation in Asia. This webinar series is brought to you by the International Valuation Standards Council and the Institute of Valuers and Appraisers, Singapore. Now, if you have just joined us, we would like to find out which topics you have been looking forward to learn more about. So let's kickstart today's session with a poll. For today's session, we will be focusing on the topic of environment, social and governance, or also known as ESG. So let us know, what do you hope to learn more about through today's session? Is it the new updates to the International Valuation Standards, or the IVS? The ESG impact on valuation? ESG information request list all about disclosures? Or you would like to gain additional insights from our speakers' professional experiences? Let's look at the answers. Okay. So this is what we have. This is what you might be interested in. Today we have about more than 300 and counting people joining us from all around Asia and possibly maybe around the world. So let's begin. For our first speaker, we will be welcoming Mr. Nicholas Cornelides, the IVSC Asia Director and the Technical Director of the Business Valuation Board. He will be sharing about the updates to the International Valuation Standards, also known as the IVS, and that's just been published in January this year. If you have any questions, please feel free to post them in the Q&A tab, and we will try to address them towards the end of the webinar. I shall hand the time now to Nicholas.
Hello, everyone. It's great to see you all. I recognize a few names, some long-standing relationships, and of course some new people interested in valuation standards and ESG and disclosures. And so let's try and kick this off. I'd just like to take a few minutes to talk about the IVSC and the standards that we promote, the international valuation standards. And so effectively the International Valuation Standard Councils has a dual mission. The first thing is that we establish and we promulgate international valuation standards, and we encourage, of course, professionalism in valuations through our local members, and of course, I'd like to acknowledge the Institute of Valuers and Appraisers of Singapore. But we have about 200 members within the IVSC from various types. Importantly, the IVSC is a global not-for-profit organization that has been around for over 40 years, and our sponsors and partners include other standard setters, multilateral organizations, regulators, valuation bodies, valuation service providers, and also the end users of valuation. Importantly, the standards are principles-based, which means that we always try to build a consensus around the best practices for valuation, but that also means that we give local regulators, local professional organizations room to implement the best rules that are applicable in their jurisdictions and for the purposes and the intended uses of those valuations. And so, because of the traction these standards are getting, we have signed several agreements with big organizations, with international organizations such as IOSCO, the International Organization of Securities Regulators, which includes MAS from Singapore, which includes SEBI from India, and the SEC from the US. We also have a working relationship with WIPO, the World Intellectual Property Organization, and other UN-related bodies. So these are the standards. It's about 160 pages, so they're not huge. And as I said, they focus very much on the principles, and they are available from our website. And so, in a nutshell, I'd like to say that the standards. There are two aspects to the standards. First of all, you have general standards, and these standards apply to all valuations, regardless of their intended use and the specifications. So, you have a valuation framework, which, by the way, references an ethical code. We have a scope of work. You have to establish a scope of work to decide what the parameters within which you're doing the valuation. You have to establish a basis of value. You have to select the appropriate valuation approach. You then have to choose from all the available data which data will be used as inputs. You have to build a valuation model. You have to do proper documentation and reporting, and then you apply the asset standards. And the asset standards fall under three categories. You can see in blue the Business Valuation Board, the Business Valuation Standards, and these include, of course, businesses and business interest, intangible assets, non-financial liabilities, and inventory. The Tangible Asset Board looks after asset standards that involve plant, equipment, and infrastructure, real property interests, development property. And finally, the financial instrument board covers, as its name indicates, financial instruments. And so with that, you really cover not only all of the valuations, but also specific characteristics of diverse assets. As we started the revision of the standards, we had to address changes in the global markets and the valuation practices. We had to, for instance, incorporate the roles and responsibility of specialists and service providers, those who have technical knowledge of specific areas. We had to align the IVS with valuation processes that had changed since the last update in 2022. We had to create standards that were primed for new types of assets and liabilities, and then we had to provide new requirements across all assets and liabilities. We were very encouraged to see that not only did the process take a long time, but above all, it gathered momentum as it went along. First of all, we had the feedback from our agenda consultation in 2021. We had some minor revisions in 2021. We then floated an exposure draft for a 90-day consultation, and eventually we got 116 responses, some of which were, frankly, longer than the standards themselves. And then we examined every single piece of feedback, and we suggested some amendments. And finally, the Standards Review Board, which is the apex board within the IVSC, voted to accept those updates. And finally, the new issue was released on the 31st of January of 2024. I would point out that the effective date for mandatory adoption will be the 31st of January 2025, but importantly, early adoption is encouraged here. So what are the changes? Very briefly, we had changes in pretty much every single item, whether it's a valuation framework, clarifying some key concepts, data and inputs, valuation models, process and quality control, documentation, and of course, an explicit reference to ESG, which we'll get back to later. So the valuation framework was expanded. There were a couple of new general standards to, I think, better espouse the workflow that valuers and people interested in valuation expect. And so we developed a valuation framework. We have general standards that really provide the requirement that are applicable across all classes of asset and liabilities, and specific requirements. Additional requirements for specific assets and liabilities. And finally, we put some material into appendices to provide additional information around some requirements. I think the key salient feature here is that some requirements, we clarified what must be followed in all valuations and what should be followed in certain circumstances, as long as you explain why you're making the choices you do. There were some distinctions between valuations and valuation reviews, and some clarification on the compliance of IVS with other legal, regulatory, and reporting standards, and that's a key point here in a number of jurisdictions and for a number of intended users. I'd like to focus a little bit on data and inputs. This is a new standard, IVS 104, that was added to address the importance of data quality in valuations, and so the imperative for valuers to maximize the use of relevant and observable data. The overarching objective here is that the data be accurate, be complete, be timely, and be transparent here. And those four adjectives are also something that you will see in valuation models. The model should be eventually accurate, complete, timely, and transparent. That's explicit in IVS 105. We integrated also valuation process quality control as a core component to ensure to minimize risks around the valuation process, and so that you reduce the valuation risk, and especially given sometimes the ambiguity around intended use, intended users, the characteristics of the asset and liability, and other issues here. So again, we try to gain clarity around the valuation process. IVS 106 it makes some explicit requirements around documentation and the requirement to maintain sufficient records. In fact, one important point here is that you don't know when the valuation might be called into question. It might be well after the valuation is actually completed and delivered to the client. So you need to document what you're doing, and you have to keep those documents available. Let's move to ESG. So this is in the revision, we have an expansion of ESG considerations in the valuation process across all assets and liabilities. But we also recognize that the impact was still evolving, and that there would be some further requirements. So regardless of, I think there are two ways of thinking of this. First of all, regardless of the valuation, the intended use of the valuation, the impact of significant ESG factors should be considered in determining the value of an asset or liability. And then there's, of course, the fact that ESG regulatory environment will also have to be considered in valuations. And those are two slightly different things, but these should be borne in mind when conducting a valuation. And I think that's the important framework here when thinking of ESG considerations. Looking at other more broad requirements, these are the minimum items that should be made explicit in any valuation. The blue ones are new additions, which in fact were implicit in the previous edition, but we've made them explicit. And note item R with the fact that if you're claiming compliance to the IVS, you should actually say so explicitly in the report. I'll go very briefly on, I'll talk very briefly about the various revisions to the asset standards. In the IVS 200 suite, the business valuation standards, there was some minimal revisions that had to do with the alignment of those asset standards to the changes in the general standards. There were few substantial changes here. In the tangible asset standards revisions, there was some expansion around data and inputs, valuation models, ESG, and documentation. It's important to note that IVS 300 now includes explicitly infrastructure. In financial instruments, and again, this is the newest of the asset standards. So it's still very much in development, and it continued to try to address the needs across all types of financial instrument valuations, including, regardless of what markets you're evolving in, all sizes of firms, whether we're talking about level 1, level 2, and level 3 securities, and so on. So this is very much in an ongoing evolution for the financial instrument asset standards. Let's think about the consideration when it comes to implementations. I think overarching, we have to think about the relationship between the valuer, the client, and the user of valuations. We also have to contend with the fundamental tension between internal and external valuation services, and also service organizations, those technical experts that we discussed. The valuation process, also the controls around this process continue to be of growing importance, both in the execution and in the results of those controls. And finally, I think the documentation of processes and really the continued reliance and the encouragement of the development of professional judgment here continues to be the hallmark of these valuation standards. In other words, the IVS are more than just a booklet. They have to foster and encourage the development and the maintenance of sound professional judgment. So what's next for the valuation standards? Well, in a few weeks, in a few months, you'll be able to voice your opinion, since we'll have an agenda consultation, which will likely encompass themes such as valuation risk, additional requirements for valuation uncertainty and proportionality, expansion and of those requirements around sustainability and ESG, and the impact of new technology on valuation, including AI, smart contracts, blockchain, and other new forms of assets. And these are really themes that are important to us and which we're working on.
Thank you so much, Nicholas. As always, if you have any questions, please feel free to post them in the Q&A tab, and we will try to address them towards the end of the webinar. Our next speaker is Ms. Srividya Gopal. She is the Managing Director and Southeast Asia Leader for Kroll's Valuation Advisory Services. She is also a member of the IVSC's Business Valuation Board. Today, she will be sharing about ESG impact on valuation, specific valuation parameters, insights from investors and capital market regulators, and some key findings from a recent roundtable discussion held in Singapore. Let me pass the time now to Srividya.
Thank you, Janine, and thanks everyone for joining. Lovely to see more than 400 participants here from across Asia, and I think a few from outside of Asia as well. This is fantastic. Warm welcome. And also thanks to Nicholas for doing a great scene setting on the changes and to the new standards and adoption, and specifically to the asset standards. I am just going to briefly take everyone through a few slides on the ESG impact, a few topics covering that. And broadly, the agenda is to talk about some of the observations from investors and regulators. The reason to look around is that from a valuation perspective, ESG is still relatively new. We do have some context on how there will be an impact, but if we look around the community of stakeholders, users of valuation, and standard setters and regulators, there is a bit more to possibly look at, which can perhaps shape the way we think about valuation around ESG. So I just thought I will capture some of those. And then, as Janine mentioned, we will briefly discuss the findings from the ESG roundtable, which happened a few months back. There was a group of participants who contributed, and they were from different asset classes around valuation and real estate and business valuations and all that. So we'll talk about that. And then we will talk about the ESG impact on valuation, briefly touch upon what could be the impact, and quickly on the data capturing that the latest IVS is talking about, which Nicholas alluded to as well. In terms of what we are seeing from stakeholders, users of valuation, and those who regulate and review valuations, investors and regulators, I think we are all aware of the ISSB standards, ISSB S1 and S2. I am not going to go much into detail because most of you must be aware of it, and I know that Suvan is going to talk about it later while covering the information request list as well. But just to give a snapshot, IFRS S1 and IFRS S2 were introduced last year. S1 is general requirement for disclosure of sustainability related information, and S2 is climate related disclosures. Both standards have already become effective from January. But having said that, a lot of the jurisdictions are currently in the process of reviewing it, doing consultation with their stakeholders and community to see how best it can be implemented in each jurisdiction. Early adoption is also allowed. And the application of the standards, either voluntary or mandatory, will be predicated on individual jurisdictions. For example, right now in Singapore, the accounting regulator, the stock exchange regulator, they're all going through this and doing consultation around it. And what it would mean is even if some jurisdictions decide not to adopt it, it might still be applicable for their, say, subsidiaries or group companies or branches in another jurisdictions where the regulators decide to adopt it. So it may have a slightly larger ramification, even if certain countries or certain regions do not adopt this. So I try to look at these standards to try and see how it could impact valuation specialists like us across different asset classes. So there is a lot in there to look at, but I just thought I will call out what is most important and relevant for us, which is highlighted in red. If you look at S1 and S2, it is very similar. One is general, one is about climate disclosures. What is most important for us as valuers is to look at these disclosure documents, disclosure standards by specific businesses, and try and get the information about all sustainability related risk and opportunities that could reasonably be expected to affect the entity's cash flows, its access to finance or cost of capital over the short, medium, or long term. So after skimming through the whole standard, this seemed to be the most important piece that stuck me for essential for valuers. And it is very similar for climate disclosure, while the same information is around climate disclosure. And S1 is about any general disclosure. So that's one side of the regulatory aspect. And then I was also trying to look at the private capital community, private equity, private credit or VC funds, sovereign wealth funds, just trying to see what is it that they are possibly doing in this space. They are definitely a few years ahead, and they've already implemented quite a bit into their own due diligence process. And there is a lot of information available publicly in the public domain for some of these institutions. I just thought I will take something from maybe like a institutional body rather than a specific fund. So there is some information that I managed to get out of the Invest Europe due diligence questionnaire that they are recommending for PE investors on their portfolio companies. It's basically a pre-transaction investment process before investment, when they do their financial DD and tax DD and legal DD, risk management. This is also something that is recommended. It's not just a pre-transaction investment process, it's also expected to be done during the post-transaction monitoring and development. So it is quite common for some of these funds to request their portfolio companies, not just at the time of investment, but also on a annual or any periodic basis to provide this kind of information to them so that they can continue monitoring and also support them in developing their sustainability and ESG related goals. So the checklist includes something which is more general, which is like a business overview, and specifically around ESG sustainability governance at the macro level. What is the process? Who are the resources? Who is responsible for this? What are their competencies? Is there a committee? Who manages the committee? Who takes those decisions? Risk register, monitoring, and reporting. So there are some high-level information that is reviewed at the ESG sustainability governance level. And then there are very specific information around the E, the S, and the G. And I've just listed out some examples on the environment, policy, permits, certifications, breaches, carbon emission, waste management, and a few others. On the social side, health and safety and accidents and all those things are up there in everybody's checklist. And then enforcements, and then a lot of people related, human capital related information, including the contracts, minimum wages, dealing with grievances, anti-discriminatory policies, migrant worker process, diversity, and all those things. And then there are governance related requirements on board structure, role of the board, corruption, fraud detection, breaches, audit committee, etc. I've also listed down like a cross section of these questions just to give a flavor of what the funds are seeking. Please detail the process you have been through to determine what ESG topics are relevant. It's at a high level, macro level, and then zooming into specific. Has the company recognized any financial provisions addressed to environmental liabilities? What is the policy on diversity and equal opportunities? What is the board composition? Is ESG a board matter? Is it discussed at the board level? And then who takes those call, who sets the agenda, and those kind of questions. So I've given the source to the details of the questionnaire as well. You can take a deeper look at it just to see how the investor community is looking at this. Similarly, on the corporate side, also a lot of corporates have similar requirements when they do transactions, when they do partnerships, when they do vendor assessments and things like that. Okay, so on the capital market side, we saw ISSB, which is required across portfolio. On the capital market side, there are several regulations as well. Firstly, I'm just primarily focusing on APAC here. APAC is a very diverse region. Every country has its own rules and regulations, and one country could be very different from the other. So from that perspective, there are a lot of diverse requirements and hence a wider extent for regulation. But there are also partnerships across some of these capital market regulators. Like the 7 Southeast Asian stock exchanges have come together as part of the Sustainable Stock Exchange Initiative. In addition, many other Asian exchanges outside of the Southeast Asia, like India, Japan, China, Australia, they are also members. They are developing some of these regulations together and supporting the Sustainable Stock Exchange Initiative. And just to again give some examples, some have implemented regulations, others have proposed those rules. Singapore Exchange has mandatory reporting requirement for climate risk and ESG factors are specified as part of the reporting. It's available on the Singapore Stock Exchange website. They also tied up with some of the rating agencies to provide these ratings on ESG. Australia has similar guidance on how to avoid greenwashing while offering or promoting sustainability related products. China has something similar. Hong Kong, Japan, all of them have similar guidelines as well. And just to again give a cross section of the parameters that these stock exchanges look at, the capital market regulators look at, something that was available in the SGX Singapore Exchange website. They're talking about the environmental factors and given certain examples around it. Similarly, social factors include gender diversity, age diversity, employment, and a whole lot of other things, health and safety for sure. And then governance, board composition, management diversity, audit committee. There are a few examples or specific factors that are cited as well. So that's on how the stakeholder community is looking at this. And I will just briefly talk about the key findings from the ESG roundtable that was conducted by IVSC. Future of Valuation, the Impact of ESG is the title of the study. And the report is available. I've given the source in the bottom of the slide. The report is available on IVSC website. You can download the report and go through it in more detail. The roundtable was, primarily to explore the integration of ESG consideration into valuation. It was hosted by Colliers International, facilitated by IVSC and RACS. To discuss, the discussion included various asset classes, including real estate and business valuation. And the dialogue centered on understanding and addressing challenges and opportunities in integrating ESG into investment strategies, as well as into the valuation profession. The summary was published in January, and like I said, you can take a look at the report. So this was done under the Chatham House rule, wherein the idea was to facilitate an open conversation in this kind of dialogue, specific participant names or who said what is not revealed, primarily to make sure people are open about their comments, and it is quite frank and a candid conversation that can take place. And in terms of some of the findings from the report and the roundtable, firstly, investing with insight, evolving role of ESG in valuation. There is a paradigm shift in the investment landscape towards incorporating ESG factors into valuation methodology. That's something that came out from most of the people who were present there. Sustainable practices are now recognized as essential, and valuation criteria have expanded to include ESG consideration. And there was specific conversation about emergence of ESG and green buildings in Singapore, where Singapore has been a leader in advocating for green buildings, and initially focused on tangible benefits around cost savings, and the moment evolved to look at incorporate green features leading to increased property value. So it's no longer just a cost saving, it is actually enhancing the value of these assets. But challenges remain in attributing value increase slowly to green features, underscoring the need for concrete evidence to support valuation differentials. Of course, there are still a lot of challenges because this subject matter is still evolving. And there was also a discussion about exploring limitation and gaps in ESG valuation. Like I said, there are clearly challenges, but regulatory support is considered crucial. Disclosure standards are considered crucial. It has to be a collaborative effort to overcome these challenges. And specifically looking at the business valuation and private company valuation, there is a clear trend incorporating ESG considerations. There are varying approaches on whether it goes into impacting cash flows, impacting cost of capital, or specific methodologies around finding comparables and things like that. The shift towards comprehensive valuation methodologies are reflect the increasing significance. So everybody agrees that it needs to be done, but people are still figuring out how to do it. And there's definitely some guidance from IVS and other standards that help us sort of get close to the end goal on that. And also there are specific mentions about the social and governance consideration. ESG considerations are expanding beyond environment. Environmental factors are the ones which still get a lot of importance, but clearly investors, stakeholders, corporates, regulators are starting to move towards the social and governance factors as well. So the concluding reflection is that ESG integration into valuation practices is irreversible, and anticipated shift towards a more balanced approach is required, and the key developments include stakeholder engagement. And now zooming into the ESG impact on valuation, which is something I'm sure you're aware and something that you're looking forward to discussing as well. There are various valuation parameters that could be impacted by ESG. Firstly, the cash flows, benefit versus cost for any ESG related expenses, or any increase in revenues in the long term. Cost of capital impacts, lower ESG rating, would they have a higher cost of capital? If you're not, for example, if a company is environmentally polluting, will they have a higher cost of raising funds and things like that? Comparable company choices, ESG ratings, which are becoming very popular as well as data sources. Where do you find this information from? Like the IFRS S1, S2, is there any other information sources that we can rely on? And things like that. And Nicholas already briefly mentioned about the IVS 2024. I'm sorry, it says under consultation, but it's already published standard. IVS 104 data and inputs specifically talk about certain factors that the valuers must consider. There are examples given for the E, the S, and a G parameters. And IVS also says that all known and available information which would affect how a market participant would assess the value of an asset should be considered. and any regulatory related considerations should be taken into effect by the valuer. That would be typically taken into account by a market participant as well. And it is not just IVS, there are other valuation standards which talk about ESG. For example, the International Private Equity Venture Capital Guideline that is primarily used by the investor community, private capital investors. The last version was updated in December 2022. They are talking about very similar impact around cash flows, comparable companies, cost of capital, and other information that needs to be considered while valuing an investment. So there is additional guidance available from some of the IVSC perspective papers on ESG and social value. I have listed this, and I think there were some questions about whether the slides will be shared. Yes, you can scan the QR code and download the slides. Not now, but once it's all uploaded in the next few days, and you can just take a look at some of these perspective papers are available on IVSC website, and you can just download them free to understand. So what are we saying ultimately in conclusion? This topic has been a focus for the regulator and investment community. Hence, it will impact valuation. I mean, we can stay away and say that, no, it really doesn't impact valuation, but it does, because that's how our entire stakeholder community is looking at it. And there are questions around whether this topic is being over-engineered. These aspects are being over-engineered. Are there too many regulations, greenwashing, extent of impact on valuation versus other parameters, cost versus benefit of the exercise? Yeah, all these challenges are still there. It is still an evolving topic, but I think we will slowly get to the goal point, likely to stay for sure and stabilize in the foreseeable future. Hopefully, we can work together with other regulators and standard setters, and this will evolve and there'll be a lot more clarity in the near future. So that is all I have today, and happy to come back later to answer any questions. Thank you so much. Back to you, Janine.
Thank you so much, Srividya. If you have any questions for our speakers, please post them using the Q&A tab. We will now take a short break before returning to hear more from our final speaker and proceed with our Q&A segment. Stay tuned for more.
The International Valuation Standards, or IVS, are globally recognized standards. IVS provides a framework for consistent and comparable valuations when used by qualified valuation professionals. This is crucial when estimating the value of anything, from real estate or businesses to financial instruments. The standards comprise two main sections. The general standards apply to all valuations, regardless of what is being valued and the purpose of the valuation. It covers matters such as what should be included in the scope of work, which basis of valuation will be applied, how data inputs and valuation models are selected and used, ESG considerations, and what documentation is necessary to ensure transparency. The asset standards provide additional requirements specific to the asset or liability being valued. This section includes chapters on business and intangible assets such as intellectual property and brands, non-financial liabilities such as environmental obligations, tangible assets such as land, real estate and equipment, and financial instruments. An IVS-compliant valuation follows the general and asset standards, promoting quality and professionalism in valuation approach and outcomes. Updated regularly by boards of international technical experts, the IVS are shaped through extensive consultation. They align with local and global regulations and are incorporated into national and professional standards in over 100 countries. IVS boosts confidence for everyone involved in the valuation process, from the valuer to the users of valuations.
Global standards such as the IBS provide benefit to the users of the standards and the users of valuations in the way that they can have a greater level of confidence that valuations prepared across countries, across regions, are prepared in a consistent basis. And that's very important in today's world where so many companies are operating globally. The latest update to IBS is really, I think, a significant step forward, an enhancement to global valuation standards.
It's really become a lot more relevant to multiple stakeholders globally, be that data providers, service providers, regulators, auditors. It reads in a way that's a lot more intuitive for those users.
IVS provides a structure that I think is going to be helpful to the valuation professional, and it really covers best practice of what we are doing or should be doing at this moment in time.
I think the biggest changes, the most significant changes are in the areas of data and models.
Some of the things that are really fantastic to see in the new edition is the chapter on data and inputs, on models, and the overall flow with how the standards now much more closely follow the process that a valuer undertakes in providing robust valuation.
From a tangible assets perspective, there's been some significant changes that have occurred with IVS 300. It's changed from plant and equipment to plant and equipment and infrastructure. We've also built out some additional content in relation to the market approach and the income approach.
IVS 500 has had some significant evolutionary updates. The perspective that we tried to take this time around was to think about the broader user base. So all the way from a larger, more sophisticated financial institutions, all the way to valuers in emerging markets.
Some of the detail on ESG, I think, has been fantastic. Stakeholders have been asking for that kind of level of detail, as well as the additions around valuation process quality controls. I think that's really, really key in terms of making sure that we are fulfilling our mission of protecting the public interest.
Welcome back to ValuAsia Connect, a webinar series on valuation in Asia. As we wait for everyone to return from their break, let us know what do you perceive as the most significant ESG challenge for valuations in Asia. Do you think it's due to limited disclosure and transparency, cultural and regulatory differences across countries, restricted access to reliable ESG data and metrics, a lack of investor awareness and education, or other reasons that have not been listed above? Tell us what you think. We'll wait for a little bit more to get more responses. Also, if you have questions, please do make use of the question and answer tab and post your questions there. It will help us to be able to sieve out questions more specifically instead of having just the chat function. All right, so we have our answers. Let's wait for a few more responses. Okay, so most people think it's because of the biggest challenge that we have for valuations in Asia is due to restricted access to reliable ESG data and metrics. That's interesting. So now, let us proceed with our final speaker before we address your questions towards the end of the session. Our third speaker is Mr. Kyo Soo-eun, Deloitte Private Leader and Private Equity Leader for Southeast Asia. He will be sharing about sample management, client information request list for ESG factors in business valuations. I will pass the time now to Soo-eun.
Okay, thank you very much, and thanks everyone for attending. Good morning, good afternoon to everyone in Asia. My segment is actually quite simple. If you're asking for a magic solution, there isn't, but I'm just going to run through what are the things that we have done so far. So the background is that 5 VPOs, as you can see up there, ASA, CBB, IVAS, and the China Appraisal Society, RICS, we have come together as valuation professional organizations to look into some of the latest issues that need further attention. And during the recent discussion, we basically picked the topic of ESG because there are lots of things being talked about on ESG as well as how it may impact valuation. Let me move on. I'm actually representing IVAS on this working group that's looking on ESG. So each of the VPOs has representative where we come together to discuss and explore how we can make the life of valuers to be a bit easier, including requesting for information. So for ESG, as many of you will be aware, especially since the start of COVID until now, that has been a major topic for discussions. Everyone is asking how does ESG affects business valuation? How does it affects the value of a certain asset class? And questions after questions, but the biggest challenge is how do we find the answer? I don't have the solution, but let's take a look. So if you are trying to navigate ESG information, you just look at the screen, not asking you all to read everything, but if you just look at the screen, there are so many ESG frameworks, the standards, the indices. Everybody claims to do something on ESG, and every country, every geographies, every association, organizations do have something about ESG. Then the question is for valuers, which one should we be looking at? If we need to understand every one of them, I think our life will be extremely complicated. Then we will become the ESG specialist rather than the valuation specialist. The good news is that at the global level, there's already a recognition that ESG needs to be looked into, but there are too many frameworks out there. So what is happening in that landscape is that organizations are coming together. People are bringing some of the guidance, principles, indices, and those that are a lot more established, especially in the climate area like TCFD, are coming together on this journey. GRI has been around for much, much longer. But with all this increased interest in how ESG may affect the value of an asset, then these organizations are all now coming together. But their objective is to ensure that the informations that are being provided are going to be relevant and hopefully reliable. So the other challenge that we are now faced with is that some of you may not be aware of IVS 104 because the old IVS 104 is talking about basis of value. The new IVS 104 is totally new section and is on data and input. And in there's an appendix that talks about ESG. So these are ESG information that could be relevant to a valuation exercise. And as Nicholas has mentioned, these are general IVS standards that's applicable for all asset classes. So whether you are doing a business valuation, you are doing a financial instruments, or you are doing intangible assets, if those informations, data, and inputs that are relevant and observable, then they should be considered for the valuation exercise. So that whatever the outcome is, it could be accurate and reliable. And what we are faced with in the ESG world is that there are so many ESG factors as well as regulatory environment that will affect the value of any assets. And the good news, we are not going to navigate this landscape ourselves because all the various bodies are coming together. And as you can see on the screen, they are trying to consolidate and trying to come together. So the most advanced now that is incorporating a lot of all these thoughts and inputs about ESG is ISSP, which we will have already covered briefly about S1 and S2, IFRS S1 and S2. So let's take a look at where are these informations coming from. So the good news is ISSP has basically bring together different organizations. Those who are from the accounting world, they would know that there's the ISP, which largely focusing on accounting standards. ISSB is now looking at the sustainability disclosure standards. And with sustainability disclosures that is coming on board, IFRS S1 and S2, the hope is that the investors and any capital markets people looking at such information will be able to form a certain value judgment. In the sustainability report, there is no quantification of what value they bring to the table, or what is the value of some of these ESG, whether they are doing better than their competitor or otherwise. There will not be any quantification of that, but what is critical is that such informations are likely to impact the overall valuation, especially if you're talking about business. Then how does that ESG elements, for example, climate, and from a climate perspective, you are going to have carbon credits. So carbon credits is a additional revenue stream, but of course there are costs related to that. Then how do you model that into our valuation model? Okay, so that's an example, but one of the biggest challenge that we also face is the different regulatory environment, because every country has something, I would say, similar but not the same. And what we hope is that the company that is providing those disclosure are able to provide the similarity as well as the differences. So as valuer, we are able to consider those. But I would say that this IFRS S1, S2 will not be implemented on everyone. Likely, what we are seeing is that it's going to be starting with those public companies, because there are a lot of stakeholders as well as investors. And if you are a private company, generally, unless you are sizable, then you have those disclosure requirements. Then the biggest question is that if you are doing a valuation on a business or a company that is below those thresholds and are not required to provide information on S1 and S2, then where are you going to get those information? So what the working group is trying to achieve is basically providing guidance in terms of what type of questions you may need to ask. And my personal take is that looking at S1 and S2, S1 I'll say generic, S2 is climate, largely driven from TCFD type of input. And if you are valuing an industry that has a lot of climate related issues, whether it's risks or opportunities, then there will be a lot of information that could be useful. A quick look at just S1 and S2. Not going through that, as I mentioned, S1 is largely general requirement, and these are broad ESG, not just the climate related or the E related. So these are a lot more broad-based. You can take your time to read those. And then on the S2 is really climate-related disclosures. So what the working group are getting to a position is that if informations are not available, then obviously we need to ask. If the informations are already prepared in the form of S1 and S2, then we should know how to navigate some of this information, because from a compliance of S1 and S2 is basically also to help investors and capital markets user of the information to be able to appraise those information. So that becomes one perspective. If they are not being provided, then would you be asking similar questions coming out from S1 and S2? But the biggest guiding principle is that those information, ESG information, has to be relevant and it has to be observable, so that the valuation, whether it's of a business or of any other assets, then you can make an accurate and reliable assessment of what could be the value. So my experience is the biggest challenge is not just ESG factor. The biggest challenge is actually the regulatory environment that is happening in every different countries. And one of those regulatory environment that is very challenging is, for example, carbon credits. It's not all countries you can generate carbon credit. It's not all countries you can register for carbon credit under the voluntary market and sell it in different countries. And the price of a carbon credit in different countries also different. So if we don't appreciate the regulatory environment of where some of these carbon credits can be generated by the company, then our whole valuation exercise will be a big challenge. And one last comment is that don't assume whatever information you receive from the client is going to be accurate and correct. If as valuers, one of the suggestions and one of the guiding principles that we are putting forward is that if in doubt and we believe that this industry should have this kind of ESG factors and we should consider such ESG factors, and if the clients are not providing, then we should be asking or challenging why is it not relevant. So that's what we have. Stay tight, stay close to us. I think we will be releasing the info request list sample to the basically all the VTOs in the near future. So thank you very much. Back to you, Jenny.
Thank you so much, Suan. So now we're moving on to the question and answer segment. Please be reminded to use the Q&A tab so that our speakers can see your questions clearly. We will try to answer as many questions as we can, so please feel free to post them and upvote the questions that others have posted as well. So let's start with one of the questions that I saw. ESG, will it be valuation risk for businesses and assets in countries where ESG focus is limited? Should we account for this risk by an increased CRP for countries where the focus on ESG is very limited? Can we perhaps have Suan to answer this question?
Yeah, but I didn't know why Jenny chose me and not Sri. But my perspective is that the way to analyze this is that how does the ESG in that country impact that business? If the business is very much domestic driven, then the ESG, if it's not relevant in that country, is likely that you may not see a lot of issues. But if you are looking at it from an external market perspective, if you are looking for international investors looking at these assets, then these particular assets in that country may not be even eligible for investment. So to me, is that we need to put it to the right context before we consider how ESG may impact the value of that particular business. So hopefully that answers your questions.
Thank you. We have two questions here about does the IVSC promote a proposed standard reporting format outline for practitioners to use? And also the second question following that is, does the IVSC certify practitioners who use the IVS? Maybe Nicholas can help us to answer this question.
Right. Those are two good questions. I would start with the second one, which is to say that the IVSC does not certify practitioners. The IVSC has members in various countries, most jurisdictions. I think it's 103 countries at the last count, and we rely on them to accredit either valuation firms or valuation individuals. And one good example of that is, of course, what's happening in Singapore, where our trusted members, our valued members like IVAS, accredit individual valuers through the CVA accreditation. Can you remind me what the first question was?
The first question was, does the IVSC promote a proposed standard operating format outline for practitioners to use?
We don't promote specific or mandate any specific format. But as you saw in my presentation, every valuation that claims compliance with the IVS should include a number of items that are listed. They're listed in the new standards, and in fact, they are they're pretty straightforward. And when you think about it, very logical. So, but the list is there; it is in the standards, without being actually a format.
Thank you, Nicholas. The next question, maybe Srividya can answer this. How are regulatory measures in Asia being coordinated with regulatory measures in other geographical areas such as Europe and its CSRD?
Great question. So there are one or two global regulatory measures, ISSB, and then EFRAG in Europe, SEC in the US. But in Asia, Asia being such a different and unique region, we have a lot more happening in Asia compared to most of the jurisdictions where these initiatives are more coordinated. So, but like I said, like I talked about some of the initiatives, the Asian jurisdictions are coordinating and cooperating with the global jurisdictions. For example, ISSB is being considered across Asia by different regulators and accounting bodies, as well as capital market bodies on how to implement, who should adopt for the IFRS S1 and S2 standards. But there is a lot more happening in Asia which are not really coordinated, which actually is a little bit difficult right now because, like Suwan said, it's like an alphabet soup. There is so many regulations to consider. Broadly, the requirements are aligned in the sense they're all talking about disclosures around ESG, but then each one has something more specific. For example, the investor regulator have something more specific. The capital markets have something more specific. So there is some coordination, but there's also a lot going on which is not coordinated, which is why this space is still evolving and people feel slightly lost. But many of the global regulations are being considered in Asia as well and being adopted by some of these regions. And I mean, Janine, since you posted that question to me, maybe I can also take on a few other questions because they were covered in my slides. And I see there are still further questions on the same topic, right? So if I can also take a few minutes to address those. Things like how can we calculate the value of ESG in valuation? What are the specific models, criteria, and also the question that Suwan already answered about the country risk premium. So there are a lot of questions on actually how to look at the impact of ESG on valuation. How do we measure the impact of ESG in valuation? So I will put it this way. We can either look at all that's going on in the world of ESG and get completely lost, right? Completely lost. Okay, so, oh my God, just two standards, IFRS S1 and S2 are talking about so much. What do we do now? And then there is SEC, there is EFRAG, there is SGX, there is MAS, and everybody's talking about their own stuff. So completely get lost. Or we can say, we are not here to do accounting or disclosures. Our focus is valuation. So what do we need as a valuer? Go back to our fundamentals. You look at valuation methodologies that are stated by the international valuation standards, cost, market, income, or any other evolved approach like real options and all that. Go back to the basics. Okay, so if we are using an income method, what can possibly be impacted by ESG? Again, go back to the slide, like just half of my slide that I actually listed those factors. Cash flows, benefit versus cost of capital. For example, if the company is not really environmentally friendly, will they be able to get a bank loan? If not, will they have to pay additional cost of capital, go to the private capital market? If the company is having reputational issues because of say child labor and things like that, will it impact their revenues in the long run? Or on the other hand, if the company has great practices, good governance, will their revenues get better in the long run? So these are the specific things that we need to ask, which is where the information request list will be helpful. And the information request list is also at a high level. Each of the valuer can make it a little more meaningful by adding a few items to it, depending on which industry that they are valuing. Ask the client those questions. Not everything might be available in an S1 or S2 document. Like Suwan said, not everybody might publish those documents. Request the client for that information and try and understand what is possible. And similarly, if you're using a market-based approach, try and understand, okay, so are we using the right comparable companies in terms of ESG compatibility, ESG ratings? Are they sort of similar? Are we looking at the right jurisdictions? I think that is the extent of which we are expected to look at this, right? Rather than say, oh, the value of the company is so much and the value of ESG is so much. I don't think anybody expects us to do that. Go back to basics, consider everything factually. We are not even doing things from a moral perspective. Yes, these are all the right things to do, but for us, it is very, very factual in terms of the measures and metrics that go into valuation. ESG ratings are available for public companies. For private companies, people are starting to publish those, but like we mentioned earlier, and some of you have alluded to, finding data is not easy. So we need to make do with whatever is available based on our Q&A with our clients or with the targets that we value. Like we always do, we ultimately arrive upon a judgment, which is based on the interview with the client and fact finding from other data sources in the public domain. And hence we try and quantify it into our basic models. So just go back to your basics, and then I think we are good for now. I don't think anything more is expected from us. And like Suan mentioned, I don't think it's a great idea to add increase country risk premium because of ESG factors, because we're not talking about countries being. I think we can't take it to such a macro perspective that some countries are ESG compliant and some are not. It is very business specific. Within the same country, it could be driven by the industry. We can't put, say, a staffing company which is providing software services to a coal mine in the same country. These have very different requirements in terms of ESG parameters. And I don't think adding a country risk premium will help. Perhaps something like a company specific premium might help, but like I said, that's not the only way to do this. It can have impacts on the cash flows, it can have impacts on the market multiples, comparable companies, or it can have impact on the cost of capital. Or if we are even looking at a replacement cost method, each item, just think through what we may have to change while we are computing a replacement cost method to consider ESG factors. So it's all about us thinking and applying our judgment based on appropriate information. And I don't think we are expecting any rocket science from the valuation community on ESG, taking into account ESG metrics and the impact of valuation. So I'll just leave it there. Happy for fellow panelists to add any comments. This is just my personal view based on whatever I've studied in the domain so far.
Thank you, Shrividya. Actually, I have another question. There is always a perception that when we think about ESG, a lot of focus is placed on environmental factors. In your opinion, this is open to any of the speakers. In your opinion, which ESG pillar has the greatest impact on valuation, and why? What is your opinion? Anybody wants to take this question?
I can start, and I think I'm sure the others have a view also. So I think historically, a lot of weight has been placed on environment. And, for example, we have a separate disclosure, which is climate disclosure, which primarily focuses on environment. I think today the world needs, to face issues and control issues like global warming and climate related stuff. It is really critical. And hence the focus has so far been primarily on environment. But honestly, the other two, the social and the governance, are also starting to see a lot more weight. And those are also very important factors. Okay, it may not be a climate disclosure related thing, but still we can't really be valuing a company which is promoting child labor or poor labor practices the same way as we value a company which values its people and trains them and things like that. And governance has always been a crux of anything business, anything regulatory, anything standard. I think governance requires an equal importance in terms of how a company is managed and audited and reviewed and right practices and things like that. So in my mind, all three are very important, but for facts that we are aware of, clearly the E has had a lot more significant weight historically.
I see. Does Suan or Nicholas want to add anything?
I'll just add and agree with Srividya. E was all the rage and was a main focus, and within E, carbon was the easiest one, or the simplest one to understand and to quantify, if not to solve. It boiled down to how many tons of carbon, and so that easy quantification, I think, made it very the primary focus of ESG. I think what we are seeing, and here this is an observation, is that the E is itself expanding to include other items such as biodiversity, for instance, water usage, and those are referenced in the standards. And then of course you have S and G, and I think that's we're observing that, and the standard setter tried to, and we as standard setters try to find the balancing point for that. We can expect more evolution on this topic, and we will have the agenda consultation out in a few weeks, and I'm pretty sure that we will be asking all of our participants and all of our stakeholders their view on exactly that, and we'll see where that leads us as standard setters.
Thank you, Nicholas. I'd like to ask Suan this question. How do you think incorporating ESG factors into valuation practices can enhance investment decision making?
Yeah, but Jenny, before that, let me just give my perspective on the impact of ESG. Yeah. I would say that we probably would never really quantify whether E or S or G contribute the most significant portion to a valuation. My perspective is that S and G has been around for a long time. And it's not something that we purposely go and dig it out and say, we look at whether this company's governance is better than another company, so we attribute more value. But if you are doing it on a comparable or earnings multiple methods, then potentially you may give it a higher multiple if it's a better governance. Or you may have better ability to do your DCF, so your discount rate, because of better governance, it may be a lower discount rate. So I would say G has been around for a long time. S probably give you the permission to run a business. If your S is so bad that you may not even able to continue with a business, then the value will be significantly bad. And S, if you don't do it well, it may affect your income, it may affect your revenue, it affects your cost. So those are already factors that we are quite used to considering them in our normal valuation models. I think the ESG with IVS 104 coming into the play, it basically get additional attention that, hey, please look into this, including the diversity. A diversity having in gender diversity, how does it impact a valuation? If we want to quantify and attribute and individually, I think that's probably too complicated. And I would say the cost vis-a-vis the benefit of allocating a value to each of these ESG elements, I don't think that's, to me, is necessary, because I don't think that serves much objective. Why E has become so popular and why everybody is paying attention is because of the change in expectation, change in regulatory environment, change in, I mean, if there's no such thing as carbon credit, nobody is going to look at carbon credit because of the interest to reduce carbon emission. Regulators, as well as voluntarily, people started with a carbon trading market. And how do you measure carbon credits? How do you actually being given carbon credits? And because of regulatory environment changes, it creates new opportunity. And that's one of the big reasons why everybody is now looking at climate. And climate basically gave rise to a lot more risk as well as opportunity. And when there's a risk and there's opportunity, that's will be a lot of things to consider, especially if you're looking at a discounted cash flow model. Energy transition is another big topic. It's also driven by climate-related interests. So I wouldn't say which one will give rise to greater value. It's more of that because of all the changes in our operating environment, it becomes something that people pay attention to. And it is a global trend. That's why everybody and every one of us around the world are talking about it. If it's only a single country regulatory environmental changes, like you can't smoke in that country, or that country say, I'm going to increase tariffs for any imported cigarettes, then it's only that country. Then you will not be able to attract so much attention. So that's my take on the ESG related in terms of how it impacts value and which one attribute to a higher value. Janice, I can't remember what was the other question already.
So, how do you think incorporating ESG factors into valuation practices can enhance investment decision making?
I would say that if we all of us take one step back, any relevant factors that affects the value of a business will affect investment decision. And the environment now is everybody is focusing on ESG, but I would say that don't go to the extreme like you are splitting hairs and trying to count every single things, but more of that if this industry has a big impact, or I would say ESG has a big impact on this industry. For example, if I'm in the oil and gas sector, I will need to seriously think about ESG because of the environment, because of the way that the investment markets look at you. And if you are not going to incorporate some of these elements into the valuation, then from an investor perspective, they are not going to be happy looking at the type of valuations that we are doing. So I would say that it's going to be industry specific, but at the same time, my advice is that don't split hairs. We are not trying to say one is better than 1.1 or is better than 0.9, because within the range of what is possible, I think that's where we are trying to get to. But if we have not considered it, then we basically have not done our job. But if you have considered it, I don't think we are able to get to a precise number. So it's likely to be a range of what is acceptable. And I think that's how I would say that what we do by incorporating some of these ESG factors, it will help the investors in looking at how ESG may affect their industry or their business.
Okay, thank you so much. We have one more question for the panel. To what extent would ESG factors be factored into the cash flow projection? To what extent factored into the discount rate? Are there typical ESG specific terminal value adjustments discussed in the profession?
I can try to answer that, Janine. There are a few questions around the same. Few people have asked the same question actually. I think there is no one rule about whether it can go into the cash flows or whether it can go into the cost of capital, right? It can be very business specific and based on the information available. For example, there can be specific ESG related expenses to support the business to become more ESG compliant. For example, training of staff or something around governance. These all could be expenses, or even something around environment to make it less polluting and things like that. It can only go into the cash flows. Similarly, there could be something around, say, government subsidies. There was a time where across the world, governments used to subsidize renewable energy, right? There was always a subsidy available by the government for non-polluting industry. So those things can only go into cash flows. There could be something else. For example, a bank is refusing to fund a coal mine or a thermal-based energy project. So they have to go to the private sector to raise money and they need to pay a slightly higher cost of capital. So this could be more a cost of capital issue. So a lot of times cost of capital is always the easy fix, and it is something that a reviewer can look at with slightly less time. But nevertheless, scenario based analysis on cash flows is quite critical. Wherever it is possible, there has to be scenario based analysis which is based on cash flows. So I would say both are important, and both are very specific to specific situations, and also information availability. Sometimes we may not have detailed information around cash flows, but intuitively know that there is an additional risk to it. That's where we cover it in the cost of capital. Terminal value adjustments would be depending on whether some of these cash flows or cost of capital adjustments are short term or long term. If we believe that these are long term, then they will go into terminal value adjustments. We put through a similar adjustments in terminal value for either the cash flows or the cost of capital, depending on whatever evaluation is for the business, for the industry, and for the specific situation. I mean, it all depends kind of an answer. I know that, but I'm trying to give in some parameters which can be considered to decide how to think about it.
Thank you. The panel can look through the questions to see if you have any final questions that you want to answer. And also, I just want to interject to say that even if we cannot answer all the questions today, all these questions will be shared with the boards and the IVSC's ESG working group to determine if we need to issue any additional information at this time. So please feel free to ask your questions, and we'll be sure to record them and bring it up to the boards for discussion. Do any of the panel speakers want to answer any of the questions that you see here? I think there's quite a few questions asking about any templates or examples to follow, and whether or not the IVSC get involved on climate risk tests involving valuation. Are valuers required to audit the information that they use as input for valuation with the recent change in the standards? Maybe Nicholas, do you want to take that question?
Yeah, sure. So we don't. The issue here is I would address, I would direct the person who asked that question to go and look at the general standards as to what the requirements around the use of specialist would mandate. So this is a big issue around how do you integrate technical information that comes from another specialist, and we tried our best to cover that in the standards. But I think that this will be an ongoing conversation, since all of these other service providers, there are more and more of them, and they add always more specialized insights into the valuation process. So I would refer that to the general standards. There's another question I would like to address here, which is more of a general issue here. That there's one questioner asking, how does a given jurisdiction that might not have a very sophisticated valuation standard infrastructure, how does it integrate that into the current valuation process? So I would just say that even if you don't claim compliance to the IVS can be a guide for best practice, regardless of what the legal regimen or the requirements are in your country. And this is really what we try to bring across to our stakeholders in countries where perhaps the practice is not so sophisticated, or it's still in flux. And so the IVS should be seen as a resource for inspiration and for professionalism, regardless of where you may be. That's all I have to say on that point here, for whatever the country, whatever country you're residing in.
Thank you, Nicholas. Do we have any final remarks from any of the panelists?
I have one. I would invite all the participants, and we had an excess of 400 people here, to subscribe to our various channels, to subscribe to our emails, because there's always a lot of new material coming up. And they really inform the valuation process. Of course, there's the standards, but more generally, we have some very, very interesting material coming out. Srividya mentioned the ESG roundtable and the report we put out on that. You have plenty of these resources. Make the most of the IVSC's resources. We are here for the public good. So don't hesitate, and we're always available by email.
Yes. You can always scan the QR code on the screen to find out more about IVSC and IVAS, as well as subscribe to the various channels that we have. I'm afraid that's all the time that we have for today. Thank you so much for being such wonderful audience and for all the questions that you have asked. Thank you, speakers, for your insightful discussions and sharings and presentation. Please do feel free to tell us what you think about this session. It's actually our very first one, and you can do so by scanning this QR code on the screen to download the slides later and to find out more. The recordings will be shared at a later date. And once again, this webinar series is brought to you by the International Valuation Standards Council and the Institute of Valuers and Appraisers Singapore. Until our next webinar, we hope you have a pleasant day ahead. Stay safe. Goodbye. Thank you.
Thank you.
Thank you. Bye-bye.
Bye-bye.
Thank you. Thanks. Bye.